Hello everyone, thank you for tuning into OptionGig, and I appreciate the time that you're gonna spend with me in this episode. You have a choice to spend time with your family or do your work or do anything that you would want to do, but instead you choose to listen to this or see this on YouTube. Oh, I really appreciate that. And my intent is to make sure I bring in the content that is useful to you. So, in this particular episode, we're not going to talk about options trading at all. Don't get me wrong, I'm not going to delve into politics or news or sports. Rather, the topic for this episode will be a little different, which is much more important to us as an investor and trader. I'm going to review the Berkshire Hathaway's annual letter to shareholders written by Mr. Warren Buffett, none other than the Oracle of Omaha. I recently got a annual report of Berkshire Hathaway because I'm a shareholder. I got that annual report in paper. Yes, I still like to get some of these annual reports in paper that I can read it physically holding the annual report. So I read through the annual report. I generally discard most of these things into the recycle bins, but since it was Berkshire Hathaway, I really wanted to go through the report and maybe make some sense out of it. So I did find that in the annual letter, there are pieces, there are tidbits of wisdom that we can learn from Mr. Buffett. And that's what I'm going to share with you. But right after this music. So don't go away. I'll be right back here. And we're going to dissect the annual letter and get some pieces of wisdom from none other than Mr. Buffett. Hello everyone, welcome to Option Gig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Thank you for staying with me. Once again, this is your host Vivek Somani, and in this episode, we're gonna dissect the annual letter from Mr. Buffett to the shareholders of Berkshire Hathaway Incorporation. Our first thing that caught my eye was the comparison of Berkshire versus S&P 500. So in the annual letter, there is a comparison of how the Berkshire Hathaway share did and how the S&P 500 did with dividends included. And the comparison is from right way back from 1965 all the way till 2019. And let's jump to the net result. Overall gain for Berkshire Hathaway shareholders from 1965 till 2019 is 2,744,062%. Yes, you heard it right. It is 2,744,062%. Compare it with S&P 500 gains of 19,784%. So if you have been Berkshire Hathaway shareholder, you're in a pretty good position. Also, this amounts to a compounded annual gain of 20.3% for Berkshire Hathaway, and S&P has returned compounded annual gain of 10%. Nothing to sneeze about it. Even 10% is good. But Berkshire 20.3% has blown the doors away. Alright, but does it mean that it has always performed given such a stellar returns? Absolutely no. If in 2019 Berkshire returned only 11%, whereas S&P 500 returned 31.5%. But again, this is not a game of 1 year. We're talking about long-term performance. Did Berkshire never had a bad year? Absolutely no. So they had a bad year in which they lost money in 1966, again in 1970, again in 1973. Whoa, whopping 1974, they lost 48.7%. But if you were a shareholder in 1974 and you lost almost 50% of the value and would have chickened out, you would have lost on all the gains that had happened later. In total, Berkshire Hathaway had 11 years where they lost money. But like I always say, it's a long-term game. You shouldn't view the performance on just year-to-year basis. 2020, if the situation stays the way it is going to be a terrible situation for all of us as an investor and a trader. Does that mean we should just chicken out and say it's not for us? No. Our horizon as an investor should be long term. So if we were in it only for a year, that was a wrong thing to begin with. So let's stay invested. Let's continue trading. Things will become better. And as you have seen in this table, the biggest lesson is the compounding. If you stay invested, continue to trade, the compounding really works. Okay, moving on to page number 3 of the letter. Mr. Buffett start with sharing the numbers here. So Berkshire earned $81.4 billion in 2019 according to GAAP. The components of that figure are $24 billion of operating earnings, $3.7 billion of realized capital gains, and a $53.7 billion gain from an increase in the amount of net unrealized capital gains. If it were any other CEO, he or she would have stopped right there. $81.4 billion in earnings. I don't need to give any explanation as a CEO. As a CEO, I should be basking in the glory, but not Mr. Buffett. He goes an extra step to explain this unrealized $53.7 billion of unrealized gain. Okay, reading from the annual report, that $53.7 billion gain requires a comment. It resulted from a new GAAP rule imposed in 2018 that requires a company holding equity securities to include in earnings the net change in the unrealized gains and losses of those securities. As we stated in last year's letter, neither Charlie Munger, my partner in managing Berkshire, nor I agree with that rule. You will never find a CEO who would say, I don't agree with the rule which is giving me $53.7 billion of earning. But here's Mr. Buffett. He says, because of this GAAP rule which was introduced in 2018, our earnings of Berkshire Hathaway has been inflated because of the gains in the unrealized gains, and that amount is $53.7 billion. And he says, I don't agree that we should include $53.7 billion in our earnings. Wow, it really takes guts for a CEO to say that. I have listened into many earnings call. I've read through the summary of many earnings report. I've never seen a CEO which says, hey, we made so much money. I think I'm not happy that we made this money because of the change and we shouldn't be counting these gains into our books. But Mr. Buffett is doing exactly the same. Not only this, he goes an extra step to explain how this GAAP rule had resulted in a crazy 90% 1,500% increase in gap earnings between 2018 and 2019. In 2018, Berkshire reported gap earnings of only $4 billion because they had to account for a decrease in the value of the stock. In 2019, they reported $81 billion because of increase in the value of a stock. That is crazy 1900% increase in gap earnings. And Mr. Buffett goes at length to explain it, to make it very clear that to shareholders that don't get blinded by increase in this gap earnings. And what he says is, Charlie and I urge you to focus on operating earnings, which were little changed in 2019, and to ignore both quarterly and annual gains or losses from investments, whether these are realized or unrealized. In net, Mr. Buffett is saying, let's not be bothered about this quarterly or annual ups and downs of stock market. This is no way of saying that those investments are not important to Berkshire, but valuing it and fretting it over every quarter doesn't make sense. Same should be the case with us as an investor. Okay, moving on, then he goes on to excuse me. Then he goes on to explain the power of retained earnings, and I'll read one important line from here is, well-managed industrial companies do not, as a rule, distribute to the shareholders the whole of their earned profits. In good years, if not in all years, they retain a part of their profits and put them back into the business. Thus, there is an element of compound interest operating in favor of a sound industrial investment. So his idea is that please don't pay all the dividends, all the profits out as a dividends to the shareholders. Invest in the business and let it compound over years in future. And I was surprised that Berkshire Hathaway hasn't paid any cash dividend since 1962. Yeah, amazing. We call him Oracle of Omaha. Berkshire Hathaway, the best stock in our generation, and they have never paid a dividend. Okay. Next, I want to talk about on if they don't pay a dividend, how Berkshire uses their earnings. So, reading on, at Berkshire, Charlie and I have long focused on using retained earnings advantageously. Sometimes this job has been easy, at other times more difficult, particularly when we began working with huge and ever-growing sums of money. No doubt, everybody keeps wondering what is Warren Buffett gonna do with the huge cash pile that he's sitting on. And I think that's why he's explaining that it has become very difficult to invest it advantageously if you have larger and larger sum of money. Next, he explains what criteria they apply to a business before they invest in. And I think we should also look into this criteria, at least understand it to guide our investments also. In addition, we constantly seek to buy new businesses that meet three criteria. First, they must earn good results on the net tangible capital required in their operation. Second, they must be run by able and honest managers. Finally, they must be available at a sensible price. Very simple. We don't need an MBA or a degree in accounting to understand this basic principle of investment, which Warren Buffett and Charlie Munger apply when they buy businesses worth billions of dollars. If they can make a decision regarding billions of dollars into these three simple criteria, I think we should also be able to use this. Again, to break it into a simple words, first criteria is that the companies must earn good returns on the amount of capital that they have invested. If I've invested $100, I should be earning at least 120. Silly, plain simple. Secondly, they talk about able and honest managers. People who are in the seat of power, people who are running the corporations need to be good. Because Berkshire doesn't run everything themselves. They have a decentralized organization, power of delegation. So they hire the best managers. Third is that it should be available at an attractive and sensible price. No point in buying a great business which is giving a great returns and run by one of the best managers if it's not even available at a price that makes sense. Plain, simple, three criteria. Next, he goes on to explain that whenever they find such business, the preference would be to buy 100% of those businesses, but many times they don't get it, so they pick up either the majority stake or a minority stake into those companies. All right, moving on. Next, they shows the list of the top 10 companies where they have a majority of their investments. I will jump right on to the page number 10, and I want to share what Mr. Buffett have to say about their holdings. Okay. Now on page number 10, they list the top 15 holdings of Berkshire Hathaway, starting with American Express Company, right the way to the Wells Fargo, and finally others. So their top 15 holdings is $248 billion of investment. Now I'm going to read what Mr. Buffett feels about that $248 billion. Charlie and I do not view the $248 billion detailed above as a collection of stock market wagers. Dalliance is to be terminated because of downgrades by the street and earnings mix, expected Federal Reserve actions, possible political developments, forecasts by economists, or whatever else might be the subject du jour. What we see in our holdings, rather, is an assembly of companies that we partly own and that on a weighted basis are earning more than 20% on the net tangible equity capital required to run their business. These companies also earn profits without employing excessive levels of debt. I think many pieces of wisdom in this. So let's break it down. Berkshire Hathaway has more than $248 billion of stock portfolio, and he says that we view it as the companies that we own and we're not bothered about what's happening in stock market. Some analysts gave a downgraded the particular stock. So what? Did they miss out on earnings for a particular quarter or a year? Don't care. Federal Reserve has announced some action, some political developments happen. It's okay. Berkshire has invested it for a long term. They're not looking to make quick buck on this and get out. They actually own the company. And the reason they own the company and want to go on long term is the criteria that they've applied. These companies run without having excessive level of debt. They're not leveraged. Also, these companies earn 20% on top of the equity capital that they need to operate the business. So these are the companies which generate returns without being leveraged. I think when we are finding out which stocks to invest in, we can pick up some of these criteria as well. Okay. Next, Mr. Buffett talks about what's the road ahead after he and Charlie Munger are no longer around. So I think he is very, very, I would say, adamant or insistent that he wants his legacy to be in Berkshire Hathaway shares only. So reading from the report, Charlie and I have a very pragmatic reasons for wanting to assure Berkshire's prosperity in the years following our exit. The Mungers have Berkshire Holdings that dwarf any of the family's other investments, and I have a full 99% of my net worth lodged in Berkshire stock. I have never sold any shares and I have no plans to do so. Then he goes on to explain a little technicality on one time when he had to sell shares in 1980 because Berkshire was buying a bank and there was a change in the bank holding company law, and because of that he had to sell a share. But the net of it is, Mr. Buffett says every penny is invested in Berkshire stock. Reading on, today my will specifically directs its executors as well as the trustees who will succeed them in administering my estate after the will is closed, not to sell any Berkshire shares. Any Berkshire shares. He wants his estate to remain invested in Berkshire shares. Okay. All right. Next, I want to talk about the topic of board of directors. While I was reading this, I could clearly see that Mr. Buffett is not happy with what's been happening in board of directors, in the boardrooms in corporate America. And I think he's now grabbing the bull by the horns and just laying everything up front around around the directors in the board, about the independence of the board of directors, and how the selection of board of directors has become really little less than perfect. Okay, so I want to read a couple of paragraphs here. Over the years, board independence has become a new area of emphasis. One key point relating to this topic, though, is almost invariably overlooked. Director compensation has now soared to a level that inevitably makes pay a subconscious factor affecting the behavior of many non-wealthy members. Think for a moment of the director earning $250 to $300,000 for board meetings, consuming a pleasant couple of days 6 or so times a year. Frequently, the possession of one such directorship bestows on its holder 3 to 4 times the annual median income of US households. Is it any wonder that a non-wealthy director now hopes or even yearns to be asked to join a second board, thereby vaulting into 500,000 to 600,000 class? To achieve this goal, the non-wealthy directors will need help. Now he talks about how CEOs look for a board of directors. Moving on. The CEO of a company searching for board members will almost certainly check with the non-wealthy director's current CEO as to whether the non-wealthy director is a quotes good director. In quotes, good, of course, is a code word. If the non-wealthy director has seriously challenged his/her present CEO's compensation or acquisition dreams, his or her candidacy will silently die. When seeking directors, CEOs don't look for pit bulls. It's the Cocker Spaniel that gets taken home. Wow. Little harsh, but it's truth. Very clearly, Mr. Buffett is saying the independence of the director is in jeopardy in corporate America, especially the directors who are not really wealthy. Directors who are still looking to make some money, because the amount of money these directors get paid is huge, and that amount subconsciously play a role when the director who is supposed to oversee the actions of CEO is sitting in front of CEO and confronting the policies of CEO, challenging the decisions of CEO, very clearly knowing that the CEO has a key to his big paycheck. Can a director in this situation still stay independent? I think that's a question which Mr. Buffett is asking. He goes on to say that he talked about a large American company and found that 8 directors had never purchased a share of the company's stock using their own money. I would feel better if I'm investing in a company and the directors of their company also have invested their own money into that company. Otherwise, if the director's own money is not at stake, I don't know how good they would be, how motivated they would be to make sure that the company is steered in the right direction. Okay. And now we are coming to the end of this letter, and last thing I want to talk about is stock repurchases. This was a phenomenon which was most talked about in 2019. Many of those 31.5% gain that we saw in stock market, a lot of that can be attributed to share buyback. And let's see what Mr. Buffett had to share about it. So I'm going to read about a few paragraphs. In past reports, we have discussed both the sense and nonsense of stock repurchases. Our thinking boiled down. Berkshire will buy back its stock only if A. Charlie and I believe that it is selling for less than it is worth, and B. The company, upon completing the repurchase, is left with ample cash. I want to bring your attention to this point B, which Mr. Buffett talked about, is that the company, upon completing the share repurchase, is left with ample cash. Contrast this to many companies who had actually borrowed money, became leveraged, and then using the borrowed money, they bought back stock. One such company comes into my mind is Boeing. They were leveraged. They bought tons of they did tons of share buyback. And now, when the situation is grim, they don't have cash on their balance sheet. Now those directors are wailing in front of government for a bailout. What a waste of taxpayers' money. Don't get me wrong. Boeing, I have a substantial holding in Boeing and I'm losing money. My portfolio is majorly it is in red because of Boeing. But I despise that the government has to bail them out. When they had a cash, they threw it on stock buybacks. Rather than using a wisdom that they should buy back the stock only if the stock is undervalued. Number two, it doesn't leave them with paupers, doesn't leave them without cash. Anyway, lastly, Mr. Buffett explains that in 2019, he found that the Berkshire price to value equation was modestly favorable for buyback. So they spent $5 billion in repurchasing 1% of the company. Not much, just 1%. Okay. That's bring us to almost to the end of this letter. So I hope you were able to get some pieces of good information, some words of advice from the Oracle of Omaha. I really enjoyed reading this annual letter. Like I said, I don't generally read these annual reports, but in Mr. Buffett letter, there were definitely a lot of hidden gems that we as a retail investor, as an individual traders can use to guide our own investment or trading philosophy. And I hope you will also be able to find and use those pieces from this episode. Thank you for spending the time. As always, if you have any questions, do not hesitate to write to me at optiongig@gmail.com. If you have any questions about your options positions, do write to me. I love reading those emails and responding to you. So don't hesitate. And also, if you want me to cover any other topic of your interest in next week, do let me know. All right. Thank you very much for your time. Happy trading. Keep safe and wash your hands, please. Goodbye.